and welcome to IDFC First Bank presents Leaders of Tomorrow, Season 11. I'm Sunanda Jayaseelan. On tonight's episode, we delve into the world of wealth management with Rahul Singh and Mohit Yadav. The panel focuses on the importance of financial literacy and diversifying investments, amongst other things. Let me come to you first, perhaps, Mohit, and ask you to really help them understand what got you so excited about being in the world of finance.
Okay, first of all, good evening, Sunanda. Thanks for having me here. So I think I was always fascinated with numbers, and the field of finance is one thing where throughout the day you have to deal with a lot of number crunching. So that was one thing, which, gave me a complete path that, okay, this is one field where I want to go ahead with. And for the marketing perspective, my view is that marketing is not something which can be learned from the books. Now, Philip Kotler is not going to tell you that, okay, how the marketing works, definitely on the bookish side, but on the practical side, that is something which an individual carries with himself. Now, finance is something which can be an acquired knowledge, and that is the reason I thought that let's go within the financial dives.
Okay, fantastic. Rahul?
Mine was more accidental. So
Accidental banker.
So I'm an engineer, electronics and telecommunication engineer, and then
I think the engineers are going into every other industry.
apart from what they're supposed to do. So my dad realized that if I build something, it's not going to last very long. So then he told me to do MBA, and then But I mean, in late 90s, the MF industry was really starting, and it was there hardly any, I think. The number of unique investors in 99 when I started was probably less than the population of Banjara Hills, where we are sitting right now. And now it is probably 5 or 6 crores. So it's really big. So I think that time it fascinated me that this is something, the industry was very new, fast growing. And, I joined a firm from South India called Sundaram Mutual Fund. And that's where my interest started.
Since we were just talking about the jewelry space and the precious metal space, my question is, should you be viewing jewelry as a form of investment? I'm talking about jewelry, I'm not just talking about, gold bars, etc. Should you not? And why or why not? To you, Rahul.
So I think it depends on an individual. The other thing for the entrepreneurs, and I think, there's... if you remember Mr. Narayan Murthy's story, when they started Infosys, it was his wife's gold which he leveraged, jewelry he leveraged, and he, I think, borrowed 10,000 rupees in 81 and started. So I think that it protects your wealth, whatever you have created, and it can be used, not only it looks good on you, but it can help you in a stage where you really need it. And I think nobody is willing to fund you because you don't have a history. And I think that is the time this jewelry as well as the precious metals can help you. So I look at it that way.
Sure. Mohit, if I can ask you to respond to that, particularly given that jewelry is seen as an emotional purchase to a large extent. So how?
Absolutely, Surinder. So I think jewelry is more of an emotional purchase rather than a kind of a purchase backed by stats and quants. So because talking about the numbers, if we see, so let me give you an example. In 1979, the Sensex when it started at 100, and right now it's above 60,000. So the return has been 600 times. And for gold, it was around 937 rupees per 10 grams. And today it's like, say, 64,000. Then also the return is around 64x. And if we compare the relative return between, investing in, say, equities or rather than investing in gold, then I can say equities beating, investing in gold by, say, 10 times. It's 10x times. So I think, again, let's not, think of jewelry as something, where you want to invest. If it's gold, that's fine. But jewelry, again, as earlier the gentleman said, it's more of a hypothetical value, right? Every particular stone is going to have a different value. It's going to differ from a store to store. So if we want to, something which is like common across all the boards. So when you want to have something like that, it cannot be something which is worth of an investment. It's investment from an emotional point of view, not from a financial point of view. And also, if you talk about the financialization of the savings, the trends which we have been seeing in the last couple of years, that the managed investment industry has seen that AUMs have doubled in the last 5 years. So it also shows that, for the financial, safeguard or the safe net, people will be moving towards like investments like equities, bond, alternate investments. But I think jewelry, let's keep jewelry to be an emotional perspective rather than a financial perspective.
Okay, since we were talking about gold with our panelists from Gold Sikka, your view on gold, I know people are talking more gold ETFs, but if you're holding, say, gold bars, gold coins, your approach to that?
So I think, diversification of a portfolio is very much necessary. And like gold plays an important role in diversification. Whenever there is a systematic risk in the market, now gold is one safe haven asset where everyone is rushing towards to. So gold will continue to be, from that point of view, gold should be a part of your portfolio, maybe 10%, 15%. It's very much liquid as well. And a great hedge for inflation. So I think my point is, let's have gold as a diversifier rather than as a pure investment. So suppose if somebody wants to invest $100, maybe $15 of that can go for gold, and the remaining can be diversified, say, in bonds and alternative, funds or equity.
I would love for both of you to also address this point on financial literacy before I open it up for questions. For small businesses today, and if you're speaking to entrepreneurs, do you feel there's enough understanding of financial literacy? There enough financially literate entrepreneurs, or what can be done really to improve that?
So I think only 1/3 of the population is financially literate. Now, what I mean by that, financial literacy means like they have the knowledge of the financial products, they have the understanding, they have the attitude to invest, they have that particular behavior where they know that, okay, in 10 years, where my investments will be like standing at. Although, sort of gauging the markets that, okay, they can understand how the markets will behave. Now, financial literacy needs to be backed by financial education. Financial education can come only when, something can be introduced in the curriculums of school and the colleges. Second, I think there is a need when the use of technology and media coverage can be used for promoting financial literacy. What I also understand is government initiatives will play a very crucial role in the coming days. So if I give you a few examples where the government has used financial intermediaries to promote the skill of financial literacy among the people. Now, how it is happening is, there are 2-3 programs which are run. I think Unnati and Saksham are those programs, and those programs particularly cater to, improving financial literacy among the masses. And what they do is, they go to, different, villages or maybe the towns, and they keep workshops. It can be a visual aid. It can be a kind of storytelling. So anything which is resonating with the people's daily lives, they try to, make them literate in that way. And also, if I talk about the banking inclusion, the way, like, the Pradhan Mantri Jan Dhan Yojana, so in the last couple of years, we have seen, like, 440 million plus accounts have got added. So the people are getting added to the financial ecosystem. And when they'll be getting added to the financial ecosystem, it becomes easy to, promote a further learning to it. So I think in the coming years, in the next 5 years or 10 years, maybe from 27% of being financial literate, we can jump to maybe double of it, 50 or 50 plus.
Sure. Just your quick take on that as well.
Yes, I think as mentioned by my colleague here, is only 1 in 4 Indians, are financial literate. This is a survey done, so they ask many questions. And the world average is, 50%. So we are way below the world average. And I think one of the reasons is that I don't think we learn anything about money in schools. So that's probably something, even a simple personal finance subject should be, introduced. So I think that's important, because the cost of delay in personal finance can, it has a magnifier impact. Just to give you a simple statistic, if you start saving at 35, or, instead of 25, your corpus at 60, whatever. It could be the same product. If you buy a fixed deposit or you buy gold, anything. And the same return, your corpus will be 3 times if you start at 25 and vis-a-vis somebody starting at 35. That's the cost of delay of 10 years. So that's massive. So I didn't know at 20, 25 what I have to do. Thankfully, I'm in this industry. But just the delay of 10 years. So that is very, very critical. And it doesn't need to be a very complicated product. Anything, time works like magic. For that, you need to start early. And I think Warren Buffett famously, he bought his first stock when he was 12. And, so I think that his secret is time. It's not people focus on the 23% return he's generated, but he's done it for 80 years. That's where the wealth is, not because of the high returns. A lot of people have done better than him, but they've done it for 5 years, not for longer. So that's...
So I would like to add one small point. So what Rahul is talking about is power of compounding. Now, power of compounding is something which we are taught in our school, but we are not taught how to, relate it to the financial aspect. Now, this connection is required.
Yeah, agreed.
I'm going to take a quick break on that note. Much more on the other side. Do stay tuned. Back in just a moment. Welcome back. With us here on IDFC First Bank presents Leaders of Tomorrow. You're watching our Springboard from Hyderabad.
Any questions from anyone here about perhaps your portfolios, how you should be rebalancing, what you should have in your portfolios?
Hello, my name is Manuel. I like the topic on financial literacy. So we talk about financial literacy. The question is, now, what level of financial literacy are we talking about? Even in schools or even for that matter, even graduates are not financially literate, right? So what level of financial literacy are we talking about? And what do you think should we cover?
So even simple things like, for example, let's say, if you use your credit card to make a simple purchase and you don't pay on time, how does it add up? Over 5-10 years is massive. You don't realize that when you make a small purchase, you don't realize that. So that's very simple. How does inflation eat away your money? So even simple things like you say, this dosa used to cost you 10 rupees and in 10 years it'll cost you 30. That thing kids don't know. In school they don't know. When, as I said, so when I was 25, I first found out that the same thing will cost me 3 times after 15 years. We all see it in daily lives. So people don't save. The education we all studied, the fees were very low. Today the fees is astronomically high, medical costs. So all of that. So even simple things like inflation, power of compounding, through examples, not very complicated stuff about investment strategy. That's what I'm referring to, what should be done.
Since you're saying credit card, I just want to, I have a question as far as credit cards for entrepreneurs, and if you could also add the IDFC First Bank perspective to this. Is it okay for entrepreneurs to use credit cards? When should you be using a credit card? If you're an entrepreneur who has that credit card, how do you make the distinction between your personal and your professional? How do you maintain that?
Yeah, so one, of course, we have one of the best products in credit cards. We start at 9% rate. Most of the market starts at 36%. So that itself gives you almost like a personal loan rate, on a credit card, which is much more convenient to use. So that's a good start. So you should use when it's an emergency, but you should try not to revolve. But one advice, as you asked Sunanda, so I think from an entrepreneur point of view, you should be able to separate your business risk and your personal wealth. That's one advice I would like to give. Most of our clients, most of our families whom we advise, they get so enamored by their business because they understand it so well. They have so much of control over their business. They keep on investing more and more in their own business. And every business, however safe it is, it may seem it carries an inherent risk. That's why you're making a higher return. Otherwise, you will make a 6%, 10-year Government of India bond gives you a 6% return. So that is a safe return. Anything above that carries a risk. right? So if your business gives you 20% return on your capital, it has risk 3 times than what the government of India is giving. So which means if you earn 100 rupees, pick a number. That number may be different for everybody. You may choose 10%, 20%, 30, but keep that aside and put that in something which is not related to your business. It could be fixed deposit, mutual funds, anything. And our team can advise you, but the idea is that separation of business risk and personal wealth, which is not done by most of the entrepreneurs.
So I want to add something to this, and I want to club the previous question this one as well. Because this example is going to talk about both the things, both the scenarios. So talking about what level of financial literacy we want to achieve. So let me give you an example, and I think this will resonate for a lot of people because many of the people when go in the college they take student loans. When somebody gets a job after the student loan, and the person is told by someone that okay, you need to start investing. Now the cost of servicing that particular debt, that particular loan which you have taken, and the investment. So see, when you're investing in the market, the kind of the return is an expected return, while the cost of servicing the debt is a real, demons standing in front of you, which you have to pay back. Now, what people are doing, they're investing on one side, while on the other side, they are, increasing the tenure of the loans. The financial literacy is something which will tell the person that no, first you need to wind up this loan, and then whatever the extra money you are getting, you have to put that into the investment. Similarly, for the credit card ones, the credit card comes with a cost as well. So financially literate person, when a lot of people have big bills on the credit cards, they keep running those bills for months, interest keeps accruing on it, and on the other side they'll say that they have SIPs running for 50K, 1 lakh and whatsoever. Now and a person who is financially literate and who understands that okay, how this will work, will first try to wipe off the loan on the credit card also.
Sure.
So what I mean to say, the financial literacy ultimately will bridge all the gaps.
Sure.
Hi, I have a question on digital gold. I buy and sell digital gold through a private bank, of course small quantities. When I buy and sell this digital gold, the profit I realize is much lesser than the equivalent value of gold. I tried to decode the charges, bank charges for digital gold. I could not do that. And what are the bank charges for digital gold? Is digital gold only for long-term investment? These are my questions. Thank you.
Honestly, I believe if somebody wants to invest in gold, so like there are launch of the ATMs, of the gold ATMs have come into the picture, so it's better to go and purchase the gold from the gold ATM rather than investing it online. That's my particular point of view.
First and foremost is, given how there is a propensity really to invest perhaps in certain stocks and certain sectors versus others, and we've been talking about some of them, including of course holding as an asset class, holding jewelry. If one were to rebalance the portfolio, and you were talking about, you mentioned that word rebalance, if any entrepreneur saying I want to rebalance my portfolio, what is the best way to go about doing that? Just a general sort of a structure if you can give us.
Okay. So firstly, to rebalance of the portfolio, it's very important to understand the risk appetite of the person. So you want to have a portfolio with a high beta or a low beta. So what I mean by that, the market sensitivity. What kind of market sensitivity you want to have in your portfolio? So suppose if there are particular sectors which are driven in particular fashion. So suppose if somebody thinks that, okay, this is good, and I'm ready to take a hit, even if the waves turn, like if the things go south, then it's fine for that particular person. But I give you an example. So somebody who wants to, take a bet on the Indian economy and the growth of India. So that person may end up, investing a lot in the infrastructure sector. The person is going to see that what was there in the budget. The budget was having 33% more allocation to the infrastructure sector this year in comparison to the previous year. So that person may end up, investing more in the infrastructure sector. But if somebody is thinking of investing for 10 years or like with a horizon of say 15 years, then definitely the person can, read about the management, read about the operations of the company, about the forecastings, about the previous balance sheets, previous cash flows, and on the basis of that, they can keep their money invested for say 5 years or 10 years.
What are the common money mistakes you see small businesses making? Anything you can give us your insights on?
I think building a credit history is very important for small businesses because that helps you creating a record and then helps you as your business grows. The banks can, lend you more money. So I think not creating enough credit history by using financial products more. So that I think, because a lot of Indian businesses still rely on personal funds, family, and all of that. So I think that credit history is important.
All right. On that note, Rahul, Mohit, thank you both so much for your time. A round of applause, ladies and gentlemen, for our experts.
That's all we could pack into tonight's conversations. If you have any feedback for us, do let us know. Our details on your screens as we speak. Thanks for watching. Have a good night.